while we are an investor in the business, we are responsible for that business. And being responsible for business, it's a heavy weight. You're responsible for the employees and their livelihoods and the health and safety of them and their communities and the users of their products. In order for us to generate the kind of returns that lead investors to want to invest in our next fund, we need to post good performance. There's a lot that could keep you awake at night.
Hello, everyone, and welcome to this week's episode of The Conscious Capitalists with myself, Timothy Henry, and my partner in making the world a better place through business, Raj Sisodia. Hey there, Raj.
Hey, Timothy. Greetings from Cabo in Mexico. I'm here by the ocean, surrounded by swimming pools and a all-inclusive resort. And guess how many times I've gone to the pool or to the ocean?
Oh, like zero.
Zero.
You've been in a small room with no windows.
No, I've got a wraparound balcony and it's just a beautiful thing, but I don't know. I'm just here working, like a writing retreat for a week, But good to see you.
Oh, good to see you. From Mexico, we have today's guest in New York, and I'm here in relatively frigid Washington, D.C., where it's below freezing today. Right. Well, today we have a special guest who I get to introduce as both a renowned financier and philanthropist. I don't often get to do that kind of introduction, but today we have the pleasure of having Stewart Kohl with us. He's co-CEO of the Riverside Company, which is a $14 billion global private equity fund founded to invest in really the smaller end of the middle market companies. So since that's where a lot of our conscious capitalist businesses are, we thought it would be great to have Stewart on to talk a little bit about his experience in investing in that market. He joined Riverside in 1993, and prior to that, he was the vice president of Citicorp Venture Capital, the private equity arm of Citibank. Now, he serves as the honorary trustee of Oberlin College, the Museum of Contemporary Art in Cleveland. He also serves on the board of directors of the Cleveland Foundation, the board of trustees of the Jewish Federation of Cleveland, as well as being a member of the board of trustees of Cleveland Clinic, where he co-chaired a $2.6 billion Power of Everyone Capital Centennial campaign, which completed in 2021. He was inducted into the Ohio Foundation of Independent Colleges Hall of Excellence. He served as the co-chair of the Building of Hope Capital campaign for the Center for Children, and he earned his George S. Dibby Entrepreneurship Award in 2018, inducted into the Northeast Ohio Business Hall of Fame, and after spending 16 years as a heavy hitter in the Pan Mass Challenge, which is out of Boston, he started Velo Sano, a similar event that has raised almost $30 million to fund cancer research at Cleveland Clinic. How about that? And on top of that, he's got a BA from Oberlin College. Stewart, welcome.
Thank you so much for the invitation. And Raj, a pleasure to meet you.
One of the things that attracts me about some of the approaches that you take is this idea of values and valuation. So in a private equity world where people often question the value of values, you guys sort of make that one of your signature things. The values and valuation go together. So talk to us a little bit about how you see that connection.
Yeah, isn't it interesting that the two words have the same root? And our observation has been that pretty predictively, companies that exhibit good values tend to grow up and to the right, and companies which round corners, which don't do things the appropriate way, may have periods of time when they appear to be very valuable, but over a longer period of time, they're not going up and to the right.
So when you talk about values, how would you even begin to define that? Or, in your world, do due diligence on it?
It's an important question. I don't have a perfect answer. I fall back on Justice Potter's definition of pornography. You kind of know it when you see it. We challenge our folks when they visit a company the very first time, and then repeatedly over time, to be assessing the values. Now, there is a like everything else at Riverside, there's a process and a form and an acronym, and they have ways to score. But a lot of it is the judgment. A lot of it comes from our investors the folks who work at Riverside who are very experienced and have, we've invested in 1,100 companies. Our folks have visited individually themselves hundreds or thousands of companies. And they're when they walk the floor, when they sit with the executives, when we try to meet not just with the top folks, but we have a theory of going at least 3 levels down in the organization.
Wow.
It starts to become clear. Sometimes it's a small whiff. Sometimes it's a big stench.
And do you look at things at all like employee engagement or any kind of employee surveys that give you some sense of whether the values are actually lived? Because of
We
course you
do.
can walk in and you can see it on the walls and everything, but
Right.
whether there's a felt sense of it is always interesting to me. And how do you do it? And what have you learned from that?
Yeah, we do some of our own surveying, but then we also rely on, today everything is scored. So before I came on today, I checked out what your Uber rating was just to make sure you were going to treat me properly during this. We all are scored all the time for our behavior, and we look at all of that as well. It's not it's not this positive. Let's face it. Directionally, indicatively, and in some cases, quite specifically, there's a lot of value there. Look, it's not the only basis we're going to make an decision whether to invest or not on, but it sure is an important one. And it sure is one that we try to get at as early as possible. Ultimately, over our period of time, a period of investment, we're going to have a pretty good sense of what the values of the business are. We just want to do it before we become responsible. Because culture is so important. This is something, obviously, you harp on in your podcast, you return to in your books, and culture is terribly important and hard to change on a dime.
What do you see? I mean, if you were trying to explain to let's say a first-year MBA class, here's the connection that we see causally between values and culture and performance.
Look, I'm no expert here, but over 37 years of doing what I do now, and 10 years of lived experience, if you will, in business before that, I believe that by and large, good people want to work for good organizations. If anything, that's becoming more, not less true with time. And that there is a link between performance and retention. And that the right values typically create organizations which have the right set of incentives and rewards. And it ultimately all gets manifested in the who. And I was extremely blessed earlier in my investing career to become I'll say a mentee of a gentleman named Mort Mandel in Cleveland. And he wrote a little book called "It's All About the Who." And it only takes about an hour to read. It's quite memorable, and I would recommend it to your listeners. But the who is so heavily really about culture, and that's so much about values.
Right now, we're in a period where it's just radical uncertainty. It's geopolitical, who knows, tariffs, not tariffs, what's happening with the US dollar. It's AI, but it's not just AI. It's robotics, it's nanotechnology. The next wave I'm hearing from Silicon Valley is, in the next 12 to 24 months, quantum computing. It's kind of really amazing business disruption. And I'm curious, when I bring that up and you go, yeah, radical uncertainty, what does that mean? And how does that affect how you talk to or manage with your portfolio companies during this period of time?
I 100% agree. We're in violent agreement about radical uncertainty. It also is a big challenge in terms of what companies and what industries we want to invest in. Once upon a time,
Yes.
if you said to me, here's 10 years of history on a business, within reason, I could make some predictions about the next 5 years or more. And that was the basis on which we move forward. And today, it's just not clear what, even before COVID, but COVID particularly threw a big wrench into the works in terms of being able to look at historical financials, because how a company performed during COVID was not necessarily predictive of anything. And then it turns out how it performed for the next couple of years after COVID wasn't necessarily predictive. And now we're into a period of where so it's a big challenge for what we can invest in. But your question is about, we've already made the investment. Now what do we do?
Yeah. Oh, but actually, before you go there, I want to come back to that, because I think that's core too. Like you're now looking forward and saying, "Hey, we have a new fund. Where we're going to invest it." That's a pretty big what if.
Yeah. And the key to that, and we can explore it further if you want, is that our folks need to be deep industry experts. And the nature, you mentioned I have the great privilege of serving on the board of the Cleveland Clinic. And today, if you show up, you present that at a sophisticated academic and medical institution with a challenge, they're not going to say, here's a general practitioner. You're going to find a specialist who deals with, left elbows. I mean, it's highly specialized. So our folks have to become highly specialized, and that means they can't cover the waterfront. That means they have to become deep experts, not just in an industry, but in subsectors in that industry. And even then, it can be extremely hard for us to predict what's going to happen.
So as you build those models and you start, what kind of assumptions do you even make about, I don't know, AI and the impact on the workforce?
Yeah, it's a big challenge. You make a set of assumptions. I think the most important thing you do is that you look at a range of outcomes, not a single point, and you determine if ultimately the business is going to perform within this range, then is that an acceptable range for the investment we're proposing? And oh, by the way, then you put that company into a portfolio of perhaps 10 companies, or 12 companies in that fund, because several of them will be outside of that range, either on the low end or the high end. But the bet is that as a portfolio, we will do well, influenced by a friend of mine who studies in the financial markets, Pat Sullivan at Monticello, and he describes portfolios as a confession of ignorance. If we knew exactly the best investment to make, you wouldn't have a portfolio. You'd have exactly one investment, but we have a portfolio.
So, Stewart, speaking of portfolios, so you completed an astounding 125 deals in 1 year?
We did, Raj, although I want to clarify that includes both platforms, which is a new company in an industry where we're specializing, and then add-ons to that company. And our typical platform will do 4 add-ons over our period of investment, but we have some that do over 20 add-ons. So that I don't want people to get the sense that we're buying like whole new companies willy-nilly.
So when you say add-ons, are you doing like a roll-up in a particular sector, or what do you mean by that?
I'm reticent to use that term, but the answer is yes. It is a term of art in our industry where you start with the platform and then you buy other companies in that industry. And if it comes to this point, and I'd be delighted if it did, because I smile when I say his name, Larry Baker, who introduced us, his company, Fleet Watcher, became a roll-up, part of a roll-up, if you will, an add-on. Again, I don't like the roll-up term at all, but it became a very strategic and accretive add-on to a platform we own called the Line Ops. And the fit of 1 + 1 there is far more than 2.
I've been playing around lately with this idea of the soul. Does every company have a soul? And what can we do to safeguard that and make sure that that is not lost, as we do transactions with companies?
That's a fascinating idea I've not heard of before, so I'm going to be interested to follow where you go with that thought. I think you're onto something. I don't know whether you watch Marcus Buckingham, follow Marcus Buckingham at all, but he's very focused right now on love. And it's a word that none of us who run companies want to use because it has a lot of connotations, but it is absolutely the term of art. When you ask somebody, if somebody really thinks they have a great job, they're probably going to say, I love my job. If they go out to a restaurant and have a good meal, they're probably going to say, I love that restaurant. It is really the gold standard of what we should be trying to achieve. And soul, I think, fits right in there along with that idea. Let me say this about culture. When we meet a company, it has a culture, and we don't go in with the idea that we're going to totally change that culture. I mean, that would be, first of all, extremely unrealistic, and second of all, I think doomed to failure. We're going to understand what that culture is. We're going to see where the culture has served the company well. If we want to own the business, we want to invest in the business, then it's performed well. And therefore, if I'm right about values and valuation and everything else, we should be starting with kind of the right ingredients. So I'll just keep probably a few times more today, pick on Larry Baker and Fleet Watcher. It had a culture. Larry has a strong culture and set of values himself, and we haven't tried to change all of that. We've tried now. The point you're getting at is how do you incorporate the two cultures of those two businesses, and that requires a lot of conversation, a lot of figuring out how they can fit together. They need to start. Maybe they don't need to be brother and sister, but they probably need to be first cousins, or I never understood how these work. Second cousin once removed, and they can't be too far apart in the way that they operate, or you are going to have problems. I would say our CEOs play an important role in that, but at companies our size, it's not always the case that we can have a CEO who has done a lot of acquisitions. So therefore, it often falls on our operating partners, and there are 80 of us at Riverside who have a different role. Their job is to help the companies we've invested in succeed, to integrate their add-ons, to have the right, ultimately the right management team for sale. And a lot of this work that we're talking about now does fall on those operating partners, and they are what I would describe as sophisticated, experienced business people who have been through multiple transactions.
So I just want to zoom out to the industry level. You're part of an industry, obviously, and every industry has its own culture in a way and way of being and so forth. But I imagine you're not quite a typical private equity firm. What would you say about where the private equity industry is currently and how you differentiate beyond your focus on values, which I think is very clear? Where do you see the state of private equity right now?
The first thing I'll say is I'm not sure there is any such thing as a typical private equity firm. There's been a spate of articles recently saying there are more private equity firms than there are McDonald's in America. I'm not sure that's accurate. There's a lot of different ways to measure that. But like all industries, it is consolidating over time. The industry has performed, extremely well over now a 4 or 5 decade period, but is going through a challenging period. Since the global financial crisis, we had a very strong recovery, and then COVID, we thought would be a very difficult period, and instead led to the best year or two in the history of Riverside and our industry, but then has been followed by 3 challenging years. And during that time, the public equity markets have performed splendidly. All of you who are watching your 401k balances or invest in the public markets see the performance there. So we are at a time where I would describe as there's a bit of a shakeout going on in the private equity industry. Within private equity, you need to nuance it further, because today you don't just have private equity. Venture capital is a large industry, but so too is real estate, private credit, infrastructure. I'm still a big believer in private equity, but it is a challenging period, and I think the net of this is going to be there'll be fewer private equity firms. The firms that remain will have deeper industry specializations, like I was talking about, and they will have more operating expertise, like I was talking about. I think those will be the hallmarks. I would like to believe they also will exhibit better values. Time will tell, but if I'm right that values correspond, then it should be no different in our industry than it is in any of the industries we invest in.
Speaking of that, I think that we've experienced a bit of a backlash in the last few years in terms of not looking at criteria other than purely financial, right? So values and meaning and purpose and those kinds of things seem to be, at least with a part of the economy, in disfavor. There are people who are just labeling all of these things as woke, right? and they want to go back to pure shareholder value maximization as a mindset. Are you seeing that in your industry as well? And how do you stay true to your belief in values, even in this environment?
There's no question that ESG, if I can use the acronym for environmental, social, and governance, was getting a lot of attention over the last 10 years and still does in many circles. But many, and I am somewhat sympathetic to this view, that simplistic approach and those three words have become, in some ways, more harmful than helpful. So you will hear less about ESG, if you will. The term that we like to use is responsible investing. And I still believe that responsible investing is something that you can, almost anybody who participates in our industry can embrace. I would be delighted to debate anybody who wants to take the position of advocating for irresponsible investing. I think I would be a relatively easy debate. And we like to show that, when we pay attention to things like energy consumption and being quote unquote more green, it correlates to higher profitability, which is ultimately what the business is going to trade on.
Yeah, well, it's interesting. We recently had a conclave with some CEOs, and I know you couldn't make it, but one of the topics
I heard about the conclave. I heard it was amazing.
Yeah, it went over pretty well. One of the topics was responsible capital. What's the future of responsible capital? Now, I know it sounds strange because, it sounds like the opposite is irresponsible capital. But the fact that you put something in front of capital and you call it responsible capital, or you put responsible investing in front of investing. And now I want to dig a little deeper. Like when you put responsible in front of investing, you put responsible in front of capital. The way it came out in our discussions was the difference between long-term and short-term thinking, decision-making, and a lot of the debate was around how do you encourage long-term frameworks for decision-making. And even more micro was, well, if you're in the public markets, it's quarterly. If you're private equity backed, it's 3 or 4 years. And yet some of these changes to really get into a company take 4 or 5 years to really be lasting. And yet there is some pressure in your industry for more short term. So I'm curious, when you put that word responsible, what are you signaling with that?
We're holding ourselves to a slightly higher standard that when we consider an investment, make an investment, and then how we take responsibility for managing that investment, we are considering all the stakeholders, if you will. That's how I think about it. You and I, Timothy, have talked about my friend Peter Georgescu and the work that he is doing. Where
seeing him on Thursday, by the way, for a couple of hours in New York.
you're in for a treat. And he's adamant and has a lot of facts to support this, that it wasn't always this way. It wasn't you could argue ever this way, that it was meant that a Milton Friedman, capitalism, the only purpose is to serve the shareholder, was the case. That's something that evolved, maybe somewhat based on greed, maybe somewhat based on cultural norms, maybe somewhat based on the evolution of particularly Delaware law. So I think the world is evolving in that direction, and I'd like to believe that there's so much we can do within almost any time frame. You're right, we do think in terms of 5 years. So when Galvanina, which is our Italian bottled water company, put solar panels on its roof, that had a payback that made that a very positive IRR, discounted cash flow, whatever measure you want to use, very high return for us. That made it an easy, quote unquote, easy investment. And I think at most companies there are lots of opportunities like that.
Well, one of the words that came up was stewardship, and that part of being a responsible capital allocator is also being stewards of the future of the businesses. And I thought that was a fascinating sort of discussion. What does it mean to be a steward and trying to ensure this
And
organization is thriving in 5 years from now? And that's the definition of what the board should be doing is, are we good stewards of the people, the culture, the stakeholders? Because as you say, ultimately, that's where value gets created and sustainable value over the long term. Because, we could all, you could create value in 2 years by just cutting costs, cutting costs, cutting costs. But is it sustainable?
yeah,
And that the stewardship word starts to drive you to sustainable value creation. And I'm curious how you have that dialogue within your organization or with the people, the LPs that you're trying to raise money from, and saying we're
yeah.
different because
Well, let me at the outset say we're not perfect, and we're definitely not saints. We and I'm using myself and my 350 colleagues, but also speaking on behalf of several thousand investors. We're in this for the returns. We're in this because we believe that there's opportunities to make money. Um, but we believe that if you kind of make money the right way, which I think does, you could argue that is basically what stewardship is about, then you are enhancing the long-term value of the company. We will get rewarded. We don't always succeed in this, but we always start out with a new investment with the idea that over a reasonable period of time, under 5 years, we're going to double or triple or more the size of the business. We're going to significantly professionalize the business. We're going to invest in the technologies that make the business more sustainable, more efficient, more successful. And then we're going to sell the business, and the market is going to be the arbiter of how much value we created through that work, or how much value we destroyed. Your point, you can always create a lot of value in 2 years, I think is an important one. But I dated myself a bit with Marcus Welby, and I will again with Chainsaw Al Dunlap, if you remember Chainsaw Al, who went in, who never met a company where he couldn't cut costs and never met an employee he couldn't fire. And I believe the record would show that just about all of his companies went bankrupt over time. So it's not I don't believe that is a winning strategy. Sometimes it is a necessity. It falls into the realm of what I call rescue capital. It's companies that have lost their way, either because of self-inflicted wounds or because their industry changed, now have to make radical changes to survive. Those radical changes often are very unpalatable and don't read well on the front page of the Wall Street Journal. But there are private equity firms that step in and try to fix and save those businesses. And my answer to them is God bless, because I'm glad we have them, because somebody needs to do it. We don't choose to do that kind of investing because it's extremely difficult. If it works, you should get a very high return, because it is very hard to do. It's not going to work always, but that's a different part of I'm talking about where we play, which is to start with what is a good to outstanding company in a fine to excellent industry. And now what are we going to do to make it more valuable? And I believe that's almost always, I like the word stewardship. I think it is always a little bit of taking a longer term view. Again, we don't always succeed at it. And, Riverside itself, with 350 people and 7 different fund families and working across 3 continents, again, investing in 1,100 companies, I guarantee you there are instances when we've been short-term in our thinking, where we've been myopic in our decisions, where we've destroyed, not created value. I mean, you can start with a lot of lofty ideals, but that when you get out, when you get punched in the face, when you start to see what it's like to actually try to implement all of that, sometimes it's hard to keep your eye on that longer term ball. Fortunately, I think the majority of the time, and hopefully more than just the majority, the vast majority of the time, we do start with that vision. We continue with that vision, and we execute on it. That's always where we start.
Stewart, you have an interesting perspective on growth, which I really like, that growth must be good, productive, and constructive. And so I talk about there's compulsive growth and there's conscious growth. Right? Compulsive growth is we have to grow by these percentages and we'll do. Doesn't matter how you do it, just get that outcome, and you end up doing things that cause harm in the long term. But conscious growth is the outcome of creating more and more value for all stakeholders, including shareholders, and that ultimately works better. So how do you look at that in practice? So how do you distinguish between healthy growth and just expansion for its own sake?
Always start our investments with an idea, strategy for what we're going to do with the business. It gets written down as our strategic plan for the business. It's something we need to get management to buy into, or they need to get us to buy into their vision. We need to come to some meeting of the minds as to what is going to be productive growth. We bring two things, I think, to our companies. One is we have a lot of folks among those 80 operating partners that fall broadly into the area of sales excellence, of helping companies to become better at selling. And that includes pricing and customer persona and sales enablement and all the disciplines that make companies better at selling. And we bring that expertise to bear so that can help to increase organic growth. And then we have a tremendous capacity to help our companies grow inorganically through M&A like we've been talking about. And we have a 20-person origination team who goes out and finds the companies, including these add-ons. And then we have the large team that can negotiate, structure, finance, and close, which is those add-on acquisitions, which most companies of the size we invest in don't have that native ability to do. And then we have those operating partners who have integrated multiple companies and help with that. So we can really make M&A inorganic growth happen. But, be careful what you wish for, because you can buy, who said, any idiot can buy a company, and you just pay too much and you own it. But are you buying the right company, and is it strategic? Is it accretive? And are you integrating it in the right ways? And I'm fond of saying that add-ons are the fastest way for us to create value, because it's almost like a step function when you get it right. But they're also the fastest way to destroy value when you get it wrong. It does get back to right where we started, which is a view of where the world is going, and we want to be growing in the areas that when we go, we're an interim owner. I sometimes don't like talking about this because it gives the wrong image. While we are an investor in the business, we are passionate about that business. We are responsible for that business. And being responsible for business means, it's a heavy weight. You're responsible for the employees and their livelihoods and the health and safety of them and their communities and the users of their products. And there's a lot that could keep you awake at night. And we take all that very seriously. So we're never casual. But in order for us to generate the kind of returns that lead investors to want to invest in our next fund, and we've been able to raise successive funds in our history because of this, we need to post good performance. So number one, we have to do something with the business. If we just pay a full price and don't do anything, we're not going to create an exciting return. And number two, we have to do something which creates value, not destroys value. Growth is generally not accidental. Growth requires a high degree of conscientiousness. And in order to generate our return, we have no choice but to find ways to make our companies bigger and better.
Related to that, we have Pete Stavros on here from KKR.
Yes.
And of course, his big passion is employee ownership. And I noticed that you're part of Ownership Works. And to what extent are you implementing that philosophy, which we see as a win-win, right? When employees have a stake, it's life-changing for them, but also beneficial ultimately for the business in significant ways. What's been your experience implementing that across your portfolio?
Very positive. We've now had one company, we only implemented it a few years ago. We've had one company already go soup to nuts and be exited, and it exited for a great outcome for our investors, and appropriately every employee shared in that outcome, and That was a very happy day. You all, I'm sure, have seen the videos of when that happened at Overhead Door for KKR, and we have our own little version of that. It's very powerful. It's very moving, and we want to do it again and again and again. But what's really interesting to me is we obviously tracked the data from when we implemented the program right up to our exit. And when you look at things like lost work time, safety, attendance, absenteeism, all those metrics went up and to the right. People behaved differently because they were felt like owners, because they were being treated like owners, and they had ownership. So Pete is a hero in my book. He's done an amazing job. We're very proud to be a small part of the Ownership Works movement, to have been relatively early to do it, and unusual for the size of deals that we do. And I would also just point out, in our industry, there aren't many private equity firms more important in scale and significance than KKR. And Pete Stavros today is not just a partner there, but he runs or co-runs the private equity practice at KKR, which says to me that cream rises to the top, and doing the right thing and everywhere matters.
Well, one of the things that, Pete also spoke at one of our CEO summits. One of the things that he emphasizes, and I think is absolutely right, he goes back to culture. It's not enough just to give employees ownership. You have to create an ownership culture. And that is a culture shift. It's like you're not just an owner, but you impact the performance of the business. And let's talk about what that impact is, and let's create that. And so I'd love to ask two questions, because the follow-on that he talked about with us was, it's all about leadership. And particularly, he's spending a lot of time now on empathy. He's thinking the future is empathetic leadership. And he's got a thing called the Empathy Gym and some other things that they're doing with their leaders. And so I'm curious, because this lines up with what we call conscious leadership, right? An organization can't be more conscious in the level of consciousness of the leader. And an organization that's trying to create an ownership culture can't be more conscious than the level of empathy, is what Pete's basically saying for the leadership. If the leadership's not on board with that kind of model, then you've got the wrong leadership. So I'm really curious how those pieces fit together now when you're thinking about going into a company and saying, oh, in this one, we're going to do employee ownership.
So we're just starting. My hope is that over time we'll do employee ownership. Ownership works in just about every company, but that's aspirational right now. That we are just starting. I do have some experience early in my career before private equity. I worked with cooperative businesses, including worker co-ops. So I do have appreciation for other ownership models.
Yeah.
I've seen both the best and the worst of them, and they're challenging. Ultimately, I like what we're doing because it's very tangible. It's something you can affect, and it seems to work on a repetitive basis. Whereas, much as I like what I saw in worker co-ops, it was a little bit lightning in a bottle, and it was hard to make it work and to maintain it. If you expand that to ESOPs, there's certainly more examples of it working, but also I think more examples where it's kind of Erschatz's ownership. It's not. It really doesn't change behavior. So, but I've seen some very good ESOP businesses, and they can work, but it does. I want to make sure I get to empathy, because we talked about soul, which is a new one for me. I'm still thinking about and excited about. We talked about love, the use of the term love, per Marcus Buckingham, and I think empathy is another word of that kind of significance, that kind of power. Great leaders are empathetic, and great leaders cause everyone around them to be better at what they do, which would imply more empathetic themselves, and hopefully that becomes a positive. So I'm not the expert on this. I'm not that wise, but I sure am supportive.
So I'm curious, like when you think about your 80 operating partners. And now you're talking about creating ownership cultures and developing more empathetic leaders. And I don't know, typically the operating partners that you probably have traditionally don't come from that school, just between the two of us, right? So, well, what does this mean in terms of like who are you putting on the boards of these companies? How are you thinking about who should be the operating partner they're working with? How, if at all, is that shifting for you?
Yeah. Well, I mean, it all comes back to Mort Mandel, my mentor, all about the who. Yeah, absolutely right. So the operating partners, maybe once upon a time, we thought of them as, if you remember those charts when you were in high school of, you crawled on all fours and then there eventually walked upright, but the operating partners were still dragging their knuckles on the ground. That is not the image for our operating partners, and ownership works. The way we implemented that, the very first thing we did was to have the an operating partner of ours become steeped in it. And I will say, to their credit, the ownership works team is very good at what they do. They're very prescriptive.
Yep.
They discourage you from kind of hacking or just trying a little bit of this or that. They want you to do it the right way, and they have a lot of resources to help you do it the right way. We need to get not just the individual operating partners to buy in, not just the CEOs of the companies to buy in, but even our own fund managers and folks at Riverside to buy in. And that's not going to happen overnight, but it's happening. And of course, the reason it's working at KKR is because it's creating value. And now we haven't spent that much time yet, sort of on the bully pulpit and talking about the importance of saving capitalism, which is at risk. But the magic of capitalism is it allows all of us to do things which are in our personal interest, but in ways that benefit the greater good. And it and by doing so, it unleashes enormous power, which you would say maybe could be done just by government coming up with the right policies and telling us what to do. But history has proven time and time again that is not a winning formula. It's not going to work because as a species, as individuals, we have other desires and needs. So to me, that's the magic of the free enterprise system and capitalism. And I hope over time, this form will be better than that form. Maybe not for every company in every industry, but in general. And that means this one will grow faster, and this one will grow slower or shrink, and we will see societal wide benefits as a result, not just company wide benefits.
So the way we describe it is we need to celebrate and elevate capitalism.
I love that. I read that and I love that.
And we got to elevate the practice of capitalism, because if we don't elevate the practice, the next generations are going to look and say, it's just rhetoric, Stewart. Like I hear it. Yeah. But you're a private equity guy. And of course you're going to say capitalism is good because, you've really benefited.
Because it's good for me.
This idea that we elevate the practice and that you're starting to experiment with how to elevate the practice is where we really start to win the hearts and minds back.
I agree.
And if we continue to practice the way we are, and then we're going to continue to lose people. And that to me is the scary part about, a lot of people have been very successful in the old model and they've benefited very well personally. And now we're sort of saying, you got to elevate the practice. You've got to be doing more of this kind of stuff. And I'm wondering how that goes over with your partners when, if you came back and said, guys, we've got to elevate the practice of capitalism and we should be on the vanguard of doing this because it's in our DNA from a values point of view.
It's it's individual, one-on-one. Everybody's going to take to it at a different pace. If we're right, and it does ultimately create more value, then more and more will embrace it. my own view is that people don't embrace it because if you say to yourself, if we want to eat as much pie as we can, um, and we're really focused on the fact that there's just that pie. So the way for me to get the most, eat the most, is to grab the most of that pie. That's one set of behavior. But if you step back and say, no, 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 that we're baking the pie. Let's bake a bigger pie. Then everyone can have more pie. And at Riverside, I do think while there's a range of opinions within the firm, I do think all of us who come and stay at Riverside, and we're very proud of having lots of people who've been with us 15, 20, 25 years. I think we're all believers that that the world is not zero sum, that there are win-win-wins, and that you can get more pie by baking a bigger one, and that's a better strategy than by uh, beating up somebody so they get less and you get more. Again, we're not saints. We're far from perfect. I'm sure there are lots of examples where we haven't always behaved that way, but I do think that's the DNA of the organization to some degree. These win-win-wins are everywhere. And if you think about private equity, that's really, in a way, the whole idea of private equity should be a win-win-win. Should be for our investors, for Riverside, for the CEOs, and now through things like Ownership Works, not just their management teams who always participated, but now all the way down, ideally, all the way to the shop floor.
Stewart, last question from me is about leadership. And you've got the unusual situation of co-CEOs in your company, which is not that common. I do think there's an inherent logic in it, especially if you bring complementary energies and strengths, that it should be a very strong positive. But why did you adopt that as a company, and what's been your experience? And do you recommend that even for your portfolio companies?
There were two of us who lead Riverside, myself and a chap named Bela Sigathi. We each grew up in New Jersey. We each went to Oberlin College. We each worked for Citibank or Citicorp. Bela was actually the founder of Riverside at his dining room table overlooking the Hudson River and Riverside Drive in Manhattan in 1988. I was at Citicorp Venture Capital at the time, learning my business, plying my trade. It was a great place to be until the early 90s when Citicorp had some reversals, particularly in real estate, and they were going to close the Cleveland office where I lived and worked. And strangely enough, I didn't want to move. So Bela very generously said, come and be my partner. We'll be 50-50 partners and co-CEOs, although we didn't use that term because there was nothing to CEO in those days. So starting in 1993, there was an office in New York with Bela, and he had Alan and Alice working with him. And I opened a little office in Cleveland, Ohio, and we have worked together now as 50-50 partners and co-CEOs for the ensuing 33 years. So what I love about this story is that I'm confident as I can be that I'm both wealthier or more affluent, however you want to describe it, and happier because I have a co-CEO partner. But I would say that, and you can ask him, but my guess is Bela would say the same thing. I'm fairly confident. And that's a proof statement of that it's not zero sum, right? I mean, it's not arguing over the slice of the pie. We spent 33, now almost 4 decades baking bigger pies. Would I recommend it for everybody? My glib answer would be, it's only going to work a certain percentage of the time, but when it does, it's going to work far better. It really comes down to the individuals and the situation. Private equity, interestingly, has far more examples of it than other industries I'm familiar with. It's true certainly for the founders, and maybe you say, okay, well, that's different. But it is interesting how many of the founders have turned the organization over to COs on the next generation too. So there's something about private equity that it nurtures it. And I think the something is, if you think about what we do for a living, it's all judgment. What company to buy, how much to pay, who should run it, what should the strategy be, when should we sell it? It's all judgment. Nobody has perfect judgment. The best judgment is going to come by having a very healthy discourse where ultimately the best idea wins. And the magic of COs is you have two people who should be perfectly aligned. Doesn't mean they agree. They each are going to bring their own perspective, but that's going to lead to the best decision. And that, I think that's why in this industry, and if you think about it, in today's world, again, from where you started, the pace of change, what was the term? Radical uncertainty. It's all judgment, and having somebody who's aligned, helping you making these judgments is a huge advantage.
And how does that play out for your portfolio companies? Do you encourage it for your portfolio companies at all, or?
We don't. If there is an arrangement like that when we start, we don't, we don't mandate that you can't do that anymore. But we don't consciously try to create it because it's such an organic thing. If it does bubble up naturally, and we've had a few instances of that, we're okay with it. Obviously, we do it. We are mindful of the fact that it isn't going to work a high percentage of the time. And when it doesn't work, there usually is fallout from that. It's usually not simple to undo. And if you're only going to own the business for 5 years, you don't want to spend 2 or 3 of them doing and undoing an arrangement. So for that reason, we don't. And the other thing I'll say is, capitalism has a lot of great aspects to it, and I can argue the pros and cons of this, but one of them is it does force companies to become efficient. And there is arguably some inherent inefficiency from having co-CEOs. Another reason I think it works in private equity is still an industry where the margins are fat enough. When it works, it's a big enough outcome that you can afford the luxury of it. If we were running grocery stores at the margin they operate at, you can't charge more for eggs to pay for the co-CEO. It's just too competitive.
Okay, are we ready for the rapid fire round, Timothy?
No.
Go for it.
You got to lean in now, Stewart. These are like quick ones. Okay, what was the first investment you ever made?
This is a strange one, but I guess it's an investment. I realized that students at Oberlin College had a real challenge getting their possessions back and forth from New York to Ohio every September and home in June. So I started a little company called Stewart Kohl, where I rented a U-Haul truck. We loaded it with their possessions. They paid like $5 a box, and we drove it back to New York and had a point where they came and picked it up and unloaded it. And you'd be amazed at how much money you can make. $5 times the number of boxes you can put in a truck.
That would be a dinner worth attending. Do you have a personal mantra, or can you make one up?
Somehow, I often end up saying the harder I work, the luckier I get.
What is the most used app on your phone other than email or texting?
Unfortunately, United Airlines is a pretty frequent one right now.
Is there a conscious business outside your portfolio that you particularly admire?
Cleveland has a company, I'll dare say neither of you or none of your folks have heard of, called Garland Industries, which is an ESOP in an industry which you might think of as a little boring and prosaic, but the performance is anything but boring or prosaic. It's performed splendidly, and because it's an ESOP, it's been tremendously beneficial to everybody that works there, and they seem to have a very special culture over time. So that would be, in my mind, a good example.
And is there a book that shaped how you lead other than It's All About the Who? We will include that, of course.
All About the Who it would definitely be the most important one. And I'm tempted to, I've got this bright yellow book behind me here, Conscious Capitalism. This answer will surprise you, and maybe as a result of it, you won't want to broadcast. But when I was a young man, a teenager, I read Dale Carnegie's book, and I know that maybe that people could make fun of that and say that there's nothing particularly conscious about it, but it was first of all, what was wrong with me as a teenager that was what I was reading, and second of all, it made an impression on me. I did see my father was a salesman, and I did see in my father's behavior aspects that I read about, and it definitely made an impression on me.
Yeah, well, nothing to be ashamed of. I mean, that's one of the original self-help books, I think, which is a huge genre in America.
I think we've evolved a lot since then, but it's probably I should go back. I should reread it. It's probably still a lot I could get from it.
And Cleveland, would you say it's the most underrated city in America?
It's definitely it's underrated. I love Cleveland in the way we talked about love before. It is an underdog city in just about every way. It's a city that people don't remember in 1900 was bigger than Chicago, the fifth largest city in the United States. When Andrew Carnegie, who was a Clevelander, decided to create the University of Chicago, it was a toss-up whether it was going to be the University of Cleveland or the University of Chicago. We have, if it was a stock, it would have been one which was a radical outperformer right up until about 1960, and sadly, in the almost 70 years since then, has been an incredible underperformer. But it is coming back, and I don't know whether either of you spends much time there. I would love for you to come out and visit, and I will show you the best of Cleveland, and the best of Cleveland is pretty darn good.
Well, I was there recently for a conference, and I got a tour around, and it was quite beautiful. And our friend David Cooperrider has been working with the mayor, in this effort in underappreciative inquiry with a vision of a green city by a blue lake.
Exactly.
I think they're succeeding.
And David, his work is outstanding. Case's work, I'm very fond of the dean of the business school now, Weatherhead, and they're doing some excellent work. So I hope people will. Thank you so much, Raj, for recognizing that.
Well, thank you, Stewart. We appreciate your time today and your insight, bringing consciousness to the private equity world and values and win-win-win philosophies and approaches. I love that. And good luck with the continued experimentation with employee ownership. I'd love to check in a couple of years and hear how that's going.
I just want to thank you for having me, but more importantly, thank you for creating this concept of conscious capitalism and advancing it. I do think the free enterprise system is at significant risk. For all its imperfections, it has lifted billions out of poverty. It has created affluence. It has created a society that is far safer, better in many ways. And I understand those imperfections, but we can't throw the baby out with the bathwater. We need to find a way to make capitalism pervasive and permanent. And the way to do that is to have more people participate and win.
And elevate the practice.
Elevate the practice. Celebrate. I like the celebration.
Thank you, Stewart, and thank you to our listeners. And if you enjoyed listening to today's show, then please feel free to hit subscribe on whatever channel you're listening to. And if you feel so moved, go over to Apple and iTunes and leave us comments and give us a score. We always love to hear from you. And thank you so much. And I'd love to thank Rainbow Productions for their support on getting this out, and for Conscious Capitalism for supporting this program overall. And thank you all, and we'll see you next week.